opinions expressed by the program participants are their own and do not reflect those of Blue Line Futures, LLC, or their affiliates. The content is for informational purposes only and should not be taken as trading advice. Futures and options trading involves a substantial risk of loss and may not be suitable for all investors. Therefore, carefully consider whether such trading is suitable for your financial condition. As a CTA, Blue Creek Capital may or may not hold positions in the assets discussed.
Hi, I'm Bill Baruch, and I'm here with my partner, Oliver Sloup, and we're the founders of Blue Line Futures, an introducing broker, and Blue Creek Capital Management, a commodity trading advisor. And this is Trade It or Fade It, a new segment where we're going to bring you some ideas that we're looking at, and you could trade it or fade it. Last week, we talked about crude oil. Did you see that fallout in crude oil last week?
It was wicked. 5 p.m. open, it gapped like $5 or $6 lower, $13 range last week, and now we're poking our head back above $70, and it's like it never happened. Crazy.
That was an air pocket. I mean, that air pocket after the Fed meeting, we had PacWest as a bank. They made some news, and there was air pockets across the board. Crude fell out, gold ripped, stocks were down, and then guess what? Things kind of, by the end of the week, things had settled right back to where they were. Yeah. Not only a $13 range to the downside, we're up 15% this week, and moving into rare major four-star resistance. This is on the research we put out every day. The Morning Express covers crude oil, rare major four-star resistance at $73.5, $74. And what we put out as a trade that we are looking at was being patient and buying some call spreads cheaper, a $78, $81 call spread for August crude oil in order to get some exposure into that gasoline seasonal that began on May 8th yesterday. So that was something we talked about last week. If you want to discuss it with us, our team, ourselves, we're always here to discuss trade ideas that we're looking at for our CTA and doing for ourselves. So don't ever hesitate to reach out. Today, though, we're going to talk about gold and wheat. You know, wheat, I know you trade a lot of wheat, but I also...
I know you eat a lot of bread, too.
Yeah, I also know that you're doing quite a bit in the metals market for yourself, I think.
Yeah, gold and silver have really piqued my interest here over the last couple of years. I've been what's referred to as stacking now. I've been buying physical gold and silver for myself and for my family. My wife has temporarily cut me off on that. That's a different conversation. But I've been bullish precious metals for the last couple of years. Hasn't been the easiest trade, but it finally feels like we're starting to get some real momentum on things with gold. Just a stone's throw away.
Yeah,
from all-time highs.
It was a breakout basically, yeah. and then it was gone. 2085 traded Wednesday night on Thursday's session. 2089 was the high going back to August of 2020, coming that pandemic rally. And now we're right back in the middle of the range. I mean, the non-farm payroll number was fairly hot, but that was the headline number. When you get into it, it wasn't as hot, but it was hot enough to get gold on its back foot, traded back down to 2007 on Friday, and we're coming right back into the middle range ahead of CPI, which is Wednesday. So CPI, which is tomorrow. And so, we've been seeing some of this hard data trend fairly well, even though CPI itself and inflation is coming down, given what energy did last month in April, given what we've seen from non-farm payroll and some of the ISMs, I'm a little fearful that we could see CPI tick up just a little bit, even though the longer-term trend remains down. So we have gold right here, it's consolidating, but I think there could be some risks of continued volatility. We may not break out just yet, although I remain very bullish on it. In our commodity trading advisor, we have a metals program. Gold's trading higher, so we keep some exposure on gold there. We trade a lot of gold in the global opportunities program, but right now I think you got to be a little cautious. And I'd be happy buying the breakout, right, get above 2100, and you can see a lot of volatility to the upside there. But if there's a seasonal at the end of the week, so I think if we get through, and we'll talk about that seasonal in next week's episode, comes in May 12th. But if we get through this week and we're holding above 1980, get through this inflation data, I think that's a good thing. Kind of tying all that data together is the Fed Watch tool on the CME's website. It takes the probabilities of Fed funds futures to give you the probability of a rate hike down these next Fed meetings. And right now, it's at about 20% chance they hike rates in June, another 25 basis points. So I think that we could see, just given the trend of some of that hard data, we could see that bump up a little bit. That would increase the dollar. That would send rates a little bit higher. And ultimately, gold might find itself on its back foot a little bit. Not saying gold needs to break down, but there might be a better entry point for a seasonal trade here. The CVOL index as well, which can be found on the CME's website. Best way to find it, go to Google search, type in CVOL, CME. I'll take you right there. And you got, that's CVOL for gold is implied volatility. It's an applied volatility tool. So it's telling us options are trading. They've become a little bit more expensive in recent weeks. It's at 18. It's not at March's high, which is 22. And then go back to the onset of the war in last year. It got to 32. So we're not at those levels, but we are a little expensive right now. We get through this CPI, PPI. We could see that CVOL potentially come down a little bit, and that would be a more attractive entry point for a trade that I would be looking at in gold. What are you looking at in wheat, though?
Well, wheat has been beaten and battered really since the start of the year, and the funds have been accumulating a very large net short position, one of their largest net short positions in over 5 years. And we pull up a commitment to traders report here from the CME group, and you can just see that it has been just a pile on as far as fund positioning goes to the short side. They're short about 127,000 futures and options contracts right now. As mentioned, that's a huge position to the short side with a lot of headline risk out there, right? We're looking at, just last week there was an attack on the Kremlin, supposedly, and that started to spark a little bit of short covering. We had a failure on the chart, but still, that risk is still there.
Yeah, if I was bearish wheat, which I'm not bearish wheat, but if I was, I couldn't imagine going home short over the weekend, short week in one of our CTA programs. I just wouldn't be able to sleep coming into Monday.
Right, and we've got the deadline for the renegotiation of the Black Sea grain corridor coming up too. That's May 18th. There's a USDA report on Friday, so a lot of headline risk out there, and everyone's on the same side of the boat. So all it takes is one thing to get everyone rushing for the exit door. And for the grain markets, wheat is it's a lot thinly traded. It's a very thinly traded market relative to corn and soybeans. So if something does happen there's a narrow exit door. So we're looking at a call spread. Now, a call spread does limit your upside potential, but I think it's a good way to get exposure in a volatile market and play for a counter trend move. All right, the path of least resistance is still and has been lower, but if you're looking for a counter trend move, looking at a call spread, we're looking at the July 670, 725 call spread. So that'd be buying the 670 call, selling the 725 call. That's 55 cents wide, and that was trading at about 11 cents this afternoon, or $550. So your max profit potential is 55 cents less the premium paid and commissions, so about 11 cents. So you're talking about 44 cents of potential upside there, $2,200, and you're laying out 11 cents or $550. So it's a 4-to-1 risk ratio, and it gives you some time too on those July options.
Yeah, I like that trade a lot. I mean, we have some exposure in long July calls for wheat in the programs. One way I like to look at when you're doing options too is having the difference of that spread. What you're paying, how many times can that go into it? That's a 5-to-1 into it. Not a payoff structure, but a 5-to-1 into that. Right. That knows you're getting some pretty decent value in purchasing a spread like that.
Right, absolutely. So
that's how we're looking at it, and you can trade it or fade it.